Welcome, everyone, to the Indiana University Maurer School of Law Tax Policy Colloquium. I'm Leandra Lederman. I'm the William W. Oliver Professor of Tax Law here at Maurer. And I'm very pleased to host today DavidHasen from the University of Florida. And so let me give you a little bit of background on him. He is, as I said, he's a professor at the University of Florida, the Levin College of Law. And he specializes in tax and tax policy. He teaches both in Florida's graduate tax program and the JD program. Prior to joining the University of Florida, Professor Hasen was a tenured faculty member at the University of Colorado Boulder. And in 2008 to 2009, he served as professor in residence at the Office of Chief Counsel of the Internal Revenue Service. Before he began his law teaching career, Professor Hasen worked as a tax associate in the San Francisco offices Wilson Sonsini and Ora Carrington, and he clerked for U.S. District Judge Maxine M. Chesney in the Northern District of California. And today he's presenting his very interesting article titled Interest Deductibility Under the Income Tax. So with that, David, the floor is all yours.
Great, thank you. Well, thank you very much for having me. I appreciate it. And I look forward to talking about this paper with you. I'm going to go ahead and share the screen here. I have some slides. All right, great. Well, thank you very much. So this is kind of an old style law review type of paper. It's kind of the classic. Let's look at a concept that's important in the law and see if we can figure it out kind of thing. I hope you all find it interesting. And I kind of begin here with this initial question, right, which is, how can this even be a question? That we've had an income tax now for more than 100 years, and we've had debt for a number of millennia. And not only that, but it seems like we ought to have a good handle on what debt is and how it works and how it interacts with the income tax, or at least a normative income tax. But like many other questions in the tax area, this one has been subject to disagreement. And so we have fairly settled rules, but a lack of consensus about whether those rules are right or what the rules should be. What I try and do here is focus on the question of interest deductibility by taking a step back and looking more broadly at why we allow cost recovery and why we allow deductions at all, and what it means to allow cost recovery and deductions. The paper actually focuses on two main questions. And one of the questions that I have for you all is whether these really belong together in one paper. They're sort of different topics, but they're related to each other, and maybe I could relate them more closely, or maybe I should just sever off the one and do that separately. The first topic is what's the proper treatment of personal interest expense, PIE, P-I-E? Should it be deductible or should it not be deductible? And here you have kind of the giants of the income tax scholarship world disagreeing on this question to some extent, which is interesting. And then the other is a slightly more sort of policy-focused question having to do with business interest expense, or BI, I'll call it, having to do with the interaction of interest deductibility and the rules for interest with Congress's decision to have accelerated cost recovery for certain types of investment. And in the latter case, it's really, the issue is when you have a sort of mix and match of tax bases that creates an arbitrage, what's the best way to handle that arbitrage? That's kind of what topic 2 is really all about. So let's start off with the first topic, PIE. Should we allow it? And the way I work through this in the paper and the way I'll work through it here is kind of go through the arguments on both sides and the objections on both sides fairly briefly, and then focus on sort of this larger question that I mentioned at the outset. What about deductions more generally? Why do we allow them? What are some reasons to disallow the deduction? So generally speaking, we're talking about interest paid in connection with debt used to finance some sort of item of personal consumption, buying a TV or a personal use automobile or even a home for that matter. The question is, should it be deductible or not, the interest? And reasons to disallow include, the main one is that it's a cost of consumption, and we generally don't subsidize payments made for consumption under the income tax. And so no deduction should be allowed in the same way that no deduction, if I buy a car for personal use, I don't get to deduct the cost. If I, buy a sandwich, I don't get to deduct the cost. There are some complexities here related to the fact that lots of items are consumed over time. So you make the outlay in period 1, and then you may have consumption occurring in periods 1 through 10 or something like that. That gets a little more nuanced, but let's set that aside for the moment. That's more of a problem under consumption tax, but it may be worth flagging, but I'm not going to talk about it very much here. What are some difficulties here? So sort of, you can make that obvious claim. Yeah, it's payment for consumption, therefore no deduction. We tend to think that, or we may tend to think that when we purchase something for consumption, that it has a market cost that everyone pays, at least everyone who's in that same market. But a borrower pays more for the consumption than a non-borrower does, at least in terms of cash flow. And so if we think that markets are functioning well, we might think, gee, the cash, the one has a greater expense than the other to derive the consumption. So maybe it would be appropriate to permit a deduction. The other thing is there's this question of what exactly are we consuming when we pay interest. And this sort of ties into the arguments that I talk about in the paper as well about the separation of the financing transaction from whatever is financed or what you use the borrowing to purchase. And there is this sort of strong strand of argument through the literature, especially in the cancellation of debt area, that says we really should treat the borrowing transaction separately from the purchase transaction. Well, if we're going to do that and follow that through consistently, what you're buying when you when you take out a loan and when you pay interest on that loan is liquidity, right? It's basically access to the use of funds that you don't otherwise own. And one can imagine consuming that in the following sense: I'm really, really happy that I have this money. That would be consumption of liquidity, right? Just like I'm really, really enjoying this sandwich or something like that. But liquidity itself seems to be purely instrumental, except for people who fetishize having money in their bank account. So there's a little bit of a question here about what's consumed. Another argument that's made for disallowing the deduction is one that's was recently put forward by Yohanahan, I'm not sure I'm pronouncing his name right, Gavati. He has an article that basically says, let's get with the program here. No one talks about these abstract concepts anymore. What they talk about is the deadweight loss and efficiency effects that are associated with one rule rather than another. And what Gavati does is he says, look, you're going to have a distortion if you don't have a proper pairing of the cost regime with the benefit regime. So if the benefit regime is non-taxed, you shouldn't get a deduction. Otherwise, you're going to have a shift of resources over to this tax favor area. So in the case of business interests, what you're financing is production of goods or services sold that are going to be taxable. So it makes sense to have a deduction there. Excuse me. In the case of consumer items or debt for personal items, that's not the case, right? If I borrow to buy the car for personal use, I get the enjoyment of the car and I don't get taxed on that consumer surplus. So he argues for a kind of symmetry regime based on the distortions that otherwise result. Again, we have this sort of question. It doesn't, same question that I mentioned earlier. What exactly is the benefit here? It's true that it's not taxed, but is there really a benefit anyway? What's the value of it? And that sort of gets to this question of whether by the value of something we mean value, be it instrumental or the as or end in itself, or is it just the end in itself, or can it also be an instrumental value? So it's a little bit unclear. Ultimately, I kind of come out where Gavati does, but for slightly different reasons. Of course, on the other side, there are reasons to allow the deduction and problems with those. So one kind of intuitive thing that I think many people point to and sort of characterize in a variety of ways, but ultimately I think they're all getting at the same thing, which is, when you're talking about debt, what you're talking about is moving money around, right? And so it has a little bit of the feel of, well, now the money's over here, now the money's over there, nothing has really happened. So there's not really any income here. So if you're going to say that is, there's not any income in the sense of creation of wealth on a global basis or on a system-wide basis, right? One person has income, interest income, but it's just money. It's just money from the other person, interest expense. It's just money moving around. There's nothing that's being created here, and so it makes sense that we not tax it, or that we provide a deduction if we're going to tax the interest income. Similarly, you can characterize borrowing as moving forward consumption in time, or moving forward some activity in time. It could be consumption or business activity, but if you're moving it forward in time, that means at the back end, later in time, you're doing less of it. And so again, it ought to be kind of a nothing for tax purposes, net. So if you're going to tax the interest income, you ought to provide a deduction for the interest expense. That's kind of the theory that I sense running through a lot of the commentary here. And so we have Dan Shaviro, we have some big names here, Jerome Kurtz, Andrews, William Andrews. So these are people who think that under a proper normative income tax, and here we're talking about kind of, very simple Hague-Simons type of income tax, you would provide a full-on deduction for all interest, assuming that you taxed all interest income. So there are some problems with these views, and I kind of go into a little detail about this in the paper. There's an argument that kind of equates, that Kurtz makes, and I think others accept, that if you do a comparison between someone who both borrows and lends and someone who does neither, to get parity, you need to provide a deduction for the interest expense. I think that argument is fundamentally mistaken, because what it fails to recognize is that if you're talking about genuine interest expense, it has to be interest expense in excess of interest income. Otherwise, it's a nothing, right? In other words, you can imagine a sort of clearer case where, although I think Kurtz's own case is pretty clear, but a clear case where I both borrow money and lend money to the same person, borrow money from and lend money to the same person. That's a nothing, right? You can dress it up however you want, but on the whole, nothing's really happening. The fact that it's different people doesn't really change that economically. And so what Kurtz is really demonstrating is that if you have, an equal and offsetting position that unwinds something that the first thing winds up, you're not really doing anything, and so it ought to be a nothing because it is nothing. But that doesn't tell you really anything about genuine interest expense. There's also another argument that Kurtz makes later on in that same paper, just in the next several paragraphs that I don't talk about here, and I suppose I could, where he kind of says another reason is to have parity between someone who consumes now and someone who consumes later. You need to provide the deduction. That strikes me as just kind of slipping into consumption tax analysis rather than income tax analysis. And the reasons that people favor consumption taxation over income taxation, which may or may not be valid, but his argument isn't really about an income tax, it's about consumption taxation. Then the last thing I talk about here is taking seriously this notion of separating the financing transaction from the purchase transaction. And this is a very strong theme that you see, and it's kind of what motivated me to write this paper. A theme that you see strongly stressed in the material on cancellation of debt. There's a lot of literature on cancellation of debt, whether it should be includable or not. There's a lot of case law on it. And when you read that literature, you get this sort of, it's almost this Promethean sort of struggle that results in where we've come to now, which is we've finally seen the light. And I think to some extent there's some accuracy there, that whether you have income or not on the cancellation of debt really doesn't have anything to do with the purchase transaction, whatever you finance with the debt. It's really kind of its own analysis, and there's a lot of literature on that. And it sort of came to fruition to some extent in the Tufts case in the Supreme Court, which had to do with cancellation of non-recourse debt. And in that case, basically the court acknowledged that or I wouldn't say acknowledged, but did the analysis in terms of kind of a relation back that really didn't look at the financing transaction at all. That is, or excuse me, the purchase transaction at all. The point was there was a benefit that the taxpayer realized by reason of the cancellation, simply by reason of the cancellation, without regard to whether whatever was financed was a success. And for that reason, the taxpayer should be taxed. And so we have this view that the borrowing in the transaction and the purchase transaction should be treated separately. And if that's true, it seems that all interest should be treated the same way, right? It doesn't say which way necessarily, it just says the same way. But then on top of that, you have this very strong intuition that business interest expense has to be deductible. In other words, no one really thinks that business interest should not be deductible under normative income tax, or at least they don't think that there shouldn't be some kind of cost recovery. And so, there's sort of a simple syllogism here, right? Which is all interest income has to be treated the same, or interest expense has to be treated the same. Business interest expense must be deductible. Personal interest expense is also interest expense. Therefore, personal interest expense must be deductible as well, right? You have to have the same rule, whatever it is, for both types of interest. And we separately have this view that we have to have a deduction for business interest. And the question here that I kind of raised and I struggled with and ultimately came to view as the correct answer here is that there are really sort of two different types of considerations that are going on here. And you can sort of frame it in the simplest terms as follows. The separation of the financing transaction from the purchase transaction goes to the question of what is income, right? If you go back to tax one, right, there are these questions that some people, I do this when I teach tax one, I kind of have these animated questions for the course. What is income? When do you have it? What's a deduction? When do you have it? That sort of stuff. Well, here it's kind of a what is income question. That's the COD question. But the when is it income or when is it a deduction question is really an entirely different question, or a substantially different question. And that's what's dictating the answer to the question about interest expense. And that in a way kind of leads into the main theme here, which is that when we're talking about deductibility of expenses or expenditures, we're really talking about a timing issue. We're not talking about a loss or anything of that nature. It's really a question of when you get to take what might be a loss, or how you account for an outlay that might produce a loss. And so that's why I kind of look at this question here. Why do we allow business deductions at all? And there's sort of a bunch of ways that you can formulate this question, and I'm trying to be mindful of the time here. So I'll move a little faster because I've got 20 slides. So business outlays really don't reflect a loss. And you could, one way to sort of understand this, and Congress has even recognized this, is that you could have an almost equivalent regime. If you didn't give any business deductions at all, but you added their cost to the cost of goods or services sold, which I'll just call CGS, right? You might have a timing issue because if the goods or services are sold in a later period and you have the outlay in the current period, then you have an outlay that doesn't produce any benefit to the taxpayer in the period in which it's made. And you have recovery of it in the form of a higher basis in whatever it is that you sell in a later period. And so you get a timing mismatch. And that might or might not be a problem. The reason it's a problem, I think the reason conceptually that it's a problem, is when you make it, the thought of making a business outlay is that you've used up whatever it is that you are purchasing. And when you use it up, all it's ever going to produce is either the immediate benefit if it's a consumer item, or potentially a benefit in the form of an increased price in whatever it is you're selling. You no longer have any property, anything that separately could be marketed or sold. When I pay for people who do work in the business to do that work, I'm now sort of committed to the idea that whatever it is they're producing is going to bear fruit. That's how I'm going to recover it. I can no longer recover it by selling the abstract labor once it's been put into something. Or to take a sort of more tangible example, if I buy pens or something like that for use in my trade or business, I can't really sell the pen anymore. The point of the pen is to be used in my trade or business. And because it's used in the trade or business, it's going to help me produce income in the form of goods or services that I sell. But it's not giving me any personal benefit now. And so the reason we give the deduction is that this combination of these two things, no immediate personal benefit, and the fact that the benefit, if any, is speculative and will be realized, if at all, when the good or service that it contributes to is sold in the market. So you could as easily, just with the timing disadvantage, possible timing mismatch, not have business deductions at all. Just have additions to the cost of goods sold. And in a way, that's sort of conceptually cleaner, because the idea is under a normative income tax, we tax all items just once. And so if you're using after-tax dollars to produce taxable income, we don't want to tax you again on it. So we just take account of that by adding it to cost of goods or services sold. And you get to the right answer. Any amounts realized above that would be additional income. Instead, what we do is we say, we're going to give you a deduction now, but then of course, we're not going to let you add it to the cost of goods or services sold. And the idea is it moves the deduction back in time and the justification or forward in time, excuse me. And the justification for moving the deduction forward in time is that the outlay itself doesn't give any personal benefit. So it's kind of a shift of presumption. You can think of it that way. So how does this, if that's right, how does this help us understand the personal interest expense question? As this kind of goes through what I just said in the last couple of minutes, so I won't restate it, but the bottom line here, deductions are a matter of legislative grace. The idea of that is you wouldn't have to provide a deduction, right? As I just said, although you would have to, if you didn't provide a deduction, I think you'd have to allow the taxpayer to include the cost, the interest expense and the cost of goods or services sold. And you do see, Section 263 Cap A is a code section that kind of implements this idea, when the idea is when the outlay that you're making actually produces something, some property that you then can sell and hang on to over some period of time. We're actually not going to give you the deduction. We're going to make you capitalize it. Okay, so what about personal interest expense? That's kind of a long wind up to this. So there should not be a deduction, in my view, because there is no future inclusion. This is similar to the Gavati argument. But you can ground it in terms of kind of the norms of an income tax rather than in efficiency considerations, which is what he does. So there's no loss that's associated with this outlay, right? The idea is that the consumption item you're buying is a consumption item you want to buy. Now, don't confuse that with sort of the question of whether you really get consumer surplus. That's kind of a separate question, right? I pay money for a movie or something like that, and I hate the movie. We don't give us a deduction, and the reason is we just, that's too hard to do, right? We could never really figure out what your genuine consumer surplus is, and so we just kind of leave that alone. And don't let that sort of issue cloud the view here. We always assume that the outlay made for personal purposes, or virtually always, produces the benefit that the taxpayer wanted it to produce. And similarly here, when you do a borrowing transaction to finance personal consumption, the same is the case. So there's no speculative aspect to it here, and there's no reason to deny the deduction. Now, what about, as I mentioned, this question of separating the financing transaction from the purchase transaction? As I mentioned earlier, and this kind of restates it, the question really is a question of what versus when. And the reason that's sort of a meaningful way to characterize why the two are different, I think, is that the when, once you recognize that a deduction is really just a when question, you can see that the when question really relates to the kind of speculative nature of a benefit that is derived from an interest outlay or any kind of deductible outlay. And that doesn't have anything to do with whether something is income or not. Really a separate question. And so I just think that the inquiry that we're making about deductions is really a timing inquiry, not a what is this thing inquiry, which is what COD is. The arguments about the financing and the purchase transaction being treated separately for COD purposes is really, the point of that is to say whether the person has income or not doesn't depend on what happened with the money you got. Getting the money itself is a benefit, assuming you don't have to pay it back. Okay, last point here, and then I'll maybe move on, is, what about the idea that the payor doesn't get, pays more if you borrow than the non-borrower? And I think this is a little bit of a red herring. There are lots of ways in which different people pay different amounts for the same consumer good. You live near the drugstore. I live far from the drugstore. You walk to the drugstore to buy whatever it is you're going to buy. I have to drive there. I have to pay for gas. I have to pay for a parking meter. All of that stuff. No one thinks that those outlays are deductible because we don't pay the same amount. Now, there is a little bit of a difference here, and this is kind of where I end up with on the question of whether there ought to be deduction for interest expense, for personal interest expense. And that is that there is a kind of systematic relationship between people who incur PI and people who don't have as many resources as others, right? In other words, if you're borrowing to finance your consumption, you're probably at the lower end of the income or wealth spectrum. You're in one of those lower cohorts. And so if our tax system wants to take vertical equity considerations into account, then I think we may want to have a deduction for personal interest expense. We might want to do that. Now, do we have to? Would it be a full deduction? Unclear. No, I don't think we have to. I don't know if it needs to be full, but you can see why you might want to have a deduction for this kind of outlay, assuming that you want to take account of vertical equity considerations. And of course we do. We have a graduated income tax, and so under a graduated income tax, of course, we're having people who have more resources pay more in the form of higher rates. And so we might want to have a deduction. On the other hand, maybe we don't. We just want to, the way we want to have preserve vertical equity is simply to have lower rates for people in lower income cohorts. But it's a way to do it. And so it's not unreasonable to do it. But if, for example, our thought is that we're just trying to tax income wherever derived without regard to how much anyone has, apart from simply levying the same rate on all income, then it seems we should not have a deduction for PI. Okay, so I've already gone on for nearly half an hour. So I could sort of quickly talk about this, Leandra, or if you prefer, we can go right to Q&A, whatever you'd rather.
We started a little bit late. I think if you want to quickly talk about this,
sure.
that sounds great. Yeah,
sure, no problem. So this is a different question, and what unites this is the question of deductibility of interest expense. That's what's driving why these two things are in the paper. But again, maybe that's kind of not really a reason to do that. So I'm interested in your thoughts on it, or maybe ways to make them sort of fit together better. Here the issue is, what should we do when we mix tax bases, which was what Congress is doing when it provides for accelerated cost recovery. So, accelerated cost recovery moves the tax base towards a consumption tax by effectively, and this is Carey-Brown theorem, and it's well understood in the income tax literature and the tax finance literature more generally, that as you move towards a consumption tax, or as you accelerate cost recovery, you move towards a consumption tax, because the consumption tax provides an immediate deduction for all outlays other than consumption outlays, essentially. And so if you have, as we now do, at least for some time, expensing of assets, then you're going to have effectively consumption tax treatment of it. And the issue here is not whether we should have consumption tax treatment of various investments under the income tax, which is an important question, but a separate question from what we're talking about here. It's rather, what do we do about the fact that we are mixing our tax bases and creating an arbitrage by reason of moving in that direction in a somewhat thoughtless way? And so in the paper, I give a kind of an example that I hope was illustrative of the problem I'm talking about here. But let me, without going through numbers or any of that here, let me just see if I can describe in words what the problem is. So in a pure cash flow consumption tax, you basically, it really is just, apart from consumption outlays, it really is just a follow the cash tax. It's a, in many ways, a simpler tax, a cash tax. And William Andrews kind of famously made this argument in a law review article almost 50 years ago about the advantages of a what he called a cash flow income tax, but what we would call is a cash flow consumption tax. And the idea is you just follow the cash, and when cash comes in, you tax it. When it goes out, unless it's for consumption in that period, you get a deduction. So borrowing under a cash flow tax is taxable. That is, if I borrow $1 million, regardless of the purpose, $1 million just came in over the transom, taxable on it. But if I take that $1 million and I invest it in a business asset, or I put it in the bank account or any kind of investment, I get a deduction. And so it's a wash. And so I'm not going to have any taxable consumption as a result of borrowing the $1 million because I'm making the investment. Conversely, when I pay off the loan, I'm going to have a deduction. And so loan proceeds are deductible. Again, just follow the cash. In an income tax, of course, we don't give you a deduction, or we don't have an, excuse me, there's no inclusion of loan proceeds and no deduction on repayment. And I think that's the right answer. I have another paper that I just wrote earlier, published earlier this year, that kind of goes on into that at some length. But the basic idea is, in an income tax, you kind of disregard the loan proceeds. And that's fine. But of course, in an income tax, you don't get a deduction for amounts invested, right? If you give cost recovery, theoretically, the cost recovery tracks the economic decline in value that results from transforming whatever it is that you've purchased for your business use into whatever you're going to sell as cost of goods sold. That goes back to what we were talking about earlier. But there's no, you don't get an immediate deduction. When you combine these two rules, though, that is, when you start moving toward a consumption tax without doing anything on the loan side, then you create an arbitrage, because now I can borrow, say, $1 million, and I have no inclusion, and I can turn around and invest that $1 million in some business asset and immediately get $1 million deduction. And so what I've done is I've dramatically turbocharged my ability to get current tax benefits. And under some, kind of plausible assumptions about interest rates and so on, you can see that the effect of this is an arbitrage. When I say arbitrage, what I mean is basically a payment from the Treasury to the taxpayer that doesn't reflect any economic value. It just represents a transfer of money from the government to private individuals. And Congress has recognized that this is a problem to some extent and has tried to deal with it. And it hasn't been all that, in my view, and I think most people's view, isn't all that effective. Currently, you see this in Section 160. I mean, there are other areas where you see this kind of thing. 163D is a provision relating to investment interest expense, which is kind of a similar problem. But in the business interest expense area, you have 163J, which is a kind of very rough means of limiting the extent to which this arbitrage is available. And so that provision, which is very complicated, although I've come to appreciate maybe needs to be that complicated, limits the availability of deductions for BIE for certain highly leveraged taxpayers. It doesn't necessarily key off of whether you've made investments in assets that provide accelerated cost recovery, though. So in that regard, and many others, it's not all that accurate. And so the question is, what's the right way to deal with this arbitrage, right? The way Congress has decided to deal with the arbitrage is, this is all just kind of reviews what I've just said. The way Congress has dealt with the arbitrage, or has tried to deal with the arbitrage, is by limiting the availability of the interest deduction, which is one way you can do it. What I suggest in the paper, and perhaps as I've thought about this a little bit more, the devil's in the details, it's not an easy problem. But what I suggest in the paper is instead that Congress could have some kind of rule for inclusion of loan proceeds, in part. to the extent that the loan is used to finance investment that has accelerated cost recovery. And CCT here refers to cash flow consumption tax, that is the limit case of accelerated cost recovery. And so, that might be a better way to do it. It has the virtue, which might just be an aesthetic virtue of kind of consistency, right? You're saying, okay, to the extent we're moving over to a consumption base, we're going to have consistent treatment of borrowing. That is, we're going to tax borrowing on a consumption base, not an income base. But it's hard to implement that. I thought a fair amount over the last couple of weeks about how to implement that in an income tax, or in our tax system, I should say. And I think it's something like the rules. There are rules for this kind of thing in the foreign tax area, where it becomes necessary to figure out the extent to which interest is paid on amounts that are invested in the U.S. as opposed to abroad. There's another area, the 265, which is interest expense incurred in connection with borrowing to finance tax-exempt income, that also kind of has some of these principles. But the basic idea is there have to be some kind of sharing or apportionment of loan proceeds between accelerated cost recovery and non-accelerated cost recovery, and some kind of inclusion. And one reason this gets really complicated is that that fluctuates over time. In other words, you could increase your borrowing in year one, reduce your borrowing in year two, adjust it again in year three, and so on. And each year you have a kind of adjustment and an inclusion or a deduction. It starts to get kind of messy. And so there have to be some ways to sort of simplify that a little bit. And once you go down that path, I don't really know the answer to that, but once you go down that path, it may not be any simpler than just denying part of the interest deduction. But that's kind of where I end up on this topic. So in any event, the idea here that I suggest in the paper is, rather than limit interest deductibility, which doesn't address kind of the inconsistent treatment of debt under the two bases that we are now combining in our actual tax base, let's do it consistently and have consistent rules for consumption tax treatment of loans when we're providing consumption tax treatment of investments. Okay, well, I'll stop there. So thanks very much for listening to the presentation, and I'm very much looking forward to your thoughts and comments.